Hey, what's up, my friend? So in today's training, I want to share with you the top 4 price action trading rules you can't afford to ignore. So let's get started. Number 1, avoid trading in the middle. So what do I mean by this? So let's say, for example, the market is kind of like in the range like this. Right, price goes up, comes down, goes up, comes down, now in the middle of the range. Many traders will be tempted to buy in this middle of the range, thinking the price, could go up higher. But the problem when you buy when the price is in the middle of the range is that where do you set a proper stop loss? Many traders will just set their stop loss a distance away from their entry point, somewhere like this. But here's the thing, right? If you understand that this market is in a range, what it could possibly do is it goes up, comes back down, goes up, comes back down, then maybe break out in one direction. So you can see that if you put your stop loss in the middle of the range because you're trading in the middle of the range, you will likely get stopped up from the noise of the market. Agree? So some of you might be thinking, okay, Rayner, I am smarter than that, right? I will not put my stop loss in the middle of the range. So what they do is price goes up, comes down, middle of the range. They put their stop loss somewhere about here. Okay, so you can see that this is the distance of your stop loss. Let's call it SL. Where is your target? Most traders will probably set their target before resistance. So this is their potential reward. So if you look at it, right, from a risk to reward standpoint, this is, I would say, mediocre, not the best, right? And again, that's because you're trading in the middle of the range, right? So again, this is better than the first scenario, but not the best. So what's a better outcome? Well, my suggestion is to be trading from an area of value. So in this case, you know that this is a range. Let's say you are looking for buying opportunity. Why not look to buy near this area of support? Your stop loss now can go outside of the range, let's say somewhere about here. Your entry, let's say it's here. So this is the size of your stop loss. Now, what about target? Again, our target, we're not changing our target. We're still referencing the resistance as our target. So now this is our potential reward. Let's call it RE. So you can see that now from a risk to reward standpoint, this trade is going to be much more favorable, and your stop loss is no longer within the noise of the market where you might get zoom stopped out. Okay, so that's the first rule that I have for you, is to avoid trading in the middle of the range. Number 2, avoid placing your stop loss just below support. Why is that? Simple, right? Let's say again, market is in a range, and again, it doesn't have to be just applied to the range market. It can be applied to uptrend, downtrend, etc. But I'm just using range because it's easier to illustrate. So market goes up, comes down, market goes up, comes down, near support, bounce up, you look to buy, and you place your stop loss just below support. Now, why is this a problem? And the reason is simple. It's because support and resistance, they are an area on your chart. This means, right, the market can reverse up higher and then slightly trickle down lower, hit your stop loss, and then goes up and hit your target over here. So remember, when you buy at support, it doesn't mean that the price has to come into support and then bounce off nicely above support. You can come into support, bounce off slightly higher, collapse down lower, trigger your stop loss, and then rally and hit your target. And this is what can happen, right, in the market. So this is why you want to avoid placing your stop loss too close, right, to your area of support. Instead, give it some distance, give it some buffer, set your stop loss away from support. So let me give you a way to do it. So let's say, for example, again, market is in a range, goes up, comes down, and you look to buy over here. Set your stop loss a distance away from support, possibly somewhere over here. So you know that if the market this time around heads down lower and reaches your stop loss over here, chances are this area of support is broken if it can slice down by so much. See where I'm coming from? So second tip is to avoid placing your stops just below support. Third thing is this: avoid chasing the market. So many traders, they love to chase the market because, oh, Rayner, look how fast this market is going. I'm just going to capture 20 pips from this market. I'm just going to capture $2 off this stock price. So market, let's say, it breaks out of a range, and then traders are looking to buy over here because the market is so bullish. Problem with this is that at this point, this is where the market is ripe to make either a complete reversal or it's ripe to make a pullback. So now, how do you capture a piece of the move safely, right, without getting caught with your pants down? So here's what I suggest. Instead of chasing the market, what you can do instead is to wait for what I call the first pullback. So it looks something like this. Let's say, again, I draw this range, I think easily 10 times in this video. Market breaks out. Let the amateur traders, right, chase the market over here. Instead, you, the professional price action trader, you will wait for the first pullback, which looks something like this, right? Market makes a pullback like this. Right, this looks something like a bull flag pattern where the market makes a slight pullback where the range of the candles get really nice and small. Then it after it makes a pullback. Okay, let's say the market makes a pullback. It starts to creep up higher. When it breaks above this highs, right? When it breaks above this highs, you can look to get long at this point. Now, what makes this different by waiting for this first pullback? Well, number 1 is you have a point of reference to set your stop loss. You now can refer this swing low to set your stop loss. You can actually set your stop loss, let's say a distance from this swing low, somewhere about here, and let's say your entry price is here. You can define your risk properly, right, by waiting for the first pullback. And the second thing is that you're not entering your trade right after the end of the pullback, which should increase the probability of the trade working out because you're no longer chasing the market. You're waiting for the pullback to occur, for the buyers to step in to start pushing the market up higher, and for the possibly for the second wave of the up move to occur before you step on board. Make sense? Okay, so this is the third thing I have for you. Avoid chasing the market. Instead, what you can do is to wait for the first pullback. And the fourth and final tip that I have for you is to avoid shorting higher lows into resistance. So many traders think that, oh, let's buy support, let's sell resistance. Well, not quite. You want to actually watch how the price action approach this area. So let's say, for example, if you see the price does this, right? You see a series of higher lows into resistance like this, okay? You want to avoid shorting, right? Because at this point, the market has a higher probability of breaking out higher rather than, reversing from resistance. And why is that? And reason is simple. It's because you see that there are buyers stepping in. That's why you have this series of higher lows, higher lows, higher lows, higher lows coming into resistance. It tells you that the buyers are willing to buy at this higher prices. This is a sign of strength, and there's a good chance the market could break out higher. So avoid shorting higher lows into resistance, and likewise avoid, buying lower highs into support. See, lower highs, lower highs, lower highs. Avoid buying lower highs into support. I hope you've enjoyed these few trading tips in today's training. If you enjoyed it, then you can get a copy of this book called Price Action Trading Secrets over here. I'll put the link somewhere below this video so you can get a copy of it. With that said, I wish you good luck, good trading. I will talk to you soon.